Hello and welcome to today's video where we talk about the ins and outs of Roth retirement accounts. Let's get started. So hopefully you've been following along in our videos and you have come to the conclusion that yes, you do need to save for retirement. Maybe you've gotten to the point where you know how much you want to contribute. And now it's time for the decision of where do I contribute that money towards a traditional retirement account or a Roth retirement account. And as a reminder, a traditional retirement account is one where the money you contribute is excluded from the salary you pay taxes on in the year in which you contribute. And in exchange for that, you must pay taxes when you take money out of your traditional retirement account after you stop working. Now, a Roth is the exact opposite. A Roth, the money that you contribute is included in your income when you file taxes in the year in which you contribute. And when you take that money out, you do not have to pay taxes on it in retirement as long as you follow the rules that pertain to that account. So today we're going to give you the ins and outs of the Roth portion because in my opinion, it's more likely that you're familiar with the traditional retirement account, but a Roth could potentially be a good part of your portfolio, and I want to explain to you some of those features so you can decide for yourself. Now we're going to talk about a lot of things that involve your taxes in this video, and again, I am not a CPA, so I would encourage you, if you hear a term or an income figure or a limitation that you want to know more about, you can actually find more information on that by going to www.irs.gov, and if you click the search bar, they have a pretty good library of resources for you to follow, so I would encourage you to do that after you watch that to make sure that you're fully informed. But let's get started. One of the first questions that you have is probably, am I even eligible to use a Roth in the first place? You see, many people used to give the advice, you need to contribute to a Roth while you still can. And that advice was very valid at the time because it used to be that the only Roth account that you could contribute towards or that existed was a Roth IRA or an individual retirement account. And the thing about Roth IRAs, even to this day, is once you exceed a certain income threshold, your ability to contribute to these accounts was phased out or even eliminated. So for example, in 2017, single taxpayers who make at or above $118,000, they begin to phase out their ability to contribute to a Roth IRA. And if you are married filing jointly at $186,000 of combined income, you also start to see your ability to contribute to a Roth phased out. So what would happen is investors who worked in fields that had pretty defined paths to higher income, so for example, a physician who is in residency and making enough that they can contribute, but they know in a few years they will not be able to meet those income requirements, they would contribute in their training years to a Roth IRA, and then once they reached that income threshold, they would shift to traditional retirement accounts. And that was just the way that people did it if they wanted to contribute to a Roth. But thankfully, in recent years, there has been the creation of Roth plans at an employer. So a 401k might offer a Roth, or a 403b at your job. They might have a Roth component as well. And thankfully, these plans do not have income limitations. So if you are beyond the thresholds of a Roth individual retirement account, but you have a Roth account available at your job, you can contribute directly to that account without being concerned that your income would preclude you from participating. So that has really changed the perception of these accounts and changed how people have utilized them in their planning. And if you're in that situation where you feel you might not be eligible, but you have one at work, I would definitely consider looking into how it would affect your finances, because you can now contribute without being concerned about eligibility, at least in these particular circumstances. Now, if you're at a place that doesn't offer that type of an account, or you're an entrepreneur, you unfortunately would still be limited to a Roth individual retirement account, which does have those income limitations. So I would encourage you to meet with your tax advisor to make sure that you know whether you truly can or cannot participate before you open an account, and they would be able to give you a really good idea of whether it's a good fit for you. Now, I can't speak for every investor, but I would wager that a major decision point between a Roth account and a traditional account is the effect of income taxes on your income now and what it might be in the future. So we went over this, but to recap again, a traditional account, you avoid paying income taxes on contributions now in exchange for paying taxes on your retirement account withdrawals in retirement. And a Roth is the opposite. You pay taxes on contributions now in exchange for not paying taxes on withdrawals in retirement. So if you are someone who thinks that you're going to have consistent income increases, or at least pretty dependable income increases over the years, then it might make sense to you to pay your taxes now on contributions by using a Roth account and not worry about that income tax burden in the future. Again, that is a major consideration that people have when making this decision. Now, there should be another consideration, and that is, even if my income does not rise significantly, what if the tax code changes in a way that doesn't benefit me? Now, contrary to popular belief, we are actually in one of the lowest tax environments in our modern history, and it would be irresponsible to plan your finances as if taxes cannot or will not increase. You just don't know, but that possibility definitely exists. So if you're looking and you're saying, hey, I don't know what the tax rate will be, but there's always the possibility that this works in my favor or against me, then there is no definitive answer for whether a Roth account or a traditional account is the right thing for you to do. But you do always have to have that in the back of your mind, that things are not necessarily guaranteed to stay the same over the next 10, 20, 30, 40 years of your life as an investor. Now, if you're someone who knows, again, that income will increase, is there a possibility that taxes could decrease? Sure, but you might want to put yourself in the camp where you say, hey, I know that this is not where I plan to stop in terms of my salary or my hourly rate. If I know that that extra money is coming, maybe it is, again, worth my time to consider paying that tax burden now so I don't have to deal with the unknown later on in my investing career. So we come across a lot of investors who see the money in their traditional retirement accounts as a wealth building tool, something to create a legacy for their future generations, because their hope is they get to retirement and they don't need all of that money. They then pass it on to the generation behind them, and it becomes a starting ground for that next generation of wealth. And while it is certainly possible that you could accumulate enough assets to do this, traditional retirement accounts do have limitations in terms of their effectiveness as a legacy building tool. You see, with a Roth retirement account, you do not owe income taxes in retirement because you've already paid them. And while it is true with the traditional account that you owe these income taxes in retirement, even if you do not need that money, the government wants to make sure it gets its taxes somewhere and somehow. And to ensure that, they've instituted what's called required minimum distributions, or RMDs. So when you reach 70 and a half in a traditional retirement account, whether you need that money or not, you are required to start taking distributions that increase every year that you attain a new age. And if you're looking for the worksheet that determines how much you have to take out, again, you can find that on www.irs.gov. But because each year that distribution increases, you could get to the point where it is much, much harder to replace what you've took out by investing the remains each year, and it diminishes its capacity as something to pass to the next generation. And even if you die before RMDs have taken a toll on your account, your next generation will still have to make these distributions based on the age that you would have been if you were alive. And because of these reasons, you can really put yourself in a position where, when comparing traditional accounts to Roth accounts, the Roth could be the clear-cut winner when it comes to the impact that income taxes have on your future generation as you pass those assets down the line. Unfortunately, more and more people are depending on Social Security as their primary source of income in retirement. As a matter of fact, in 2014, a study by AARP found that Social Security represents 90% of income for 23% of recipients age 65 or older. And we certainly hope that the tips that we share can help you avoid that situation, but it's clear that maximizing your Social Security is a big deal. And when you're using traditional retirement accounts for income, however, you risk having those Social Security benefits subject to income taxes. So for people taking Social Security, the IRS looks at something called your provisional income to determine if your benefits are taxable. And again, if you want to see the formula for provisional income, it's available on the IRS website. But single taxpayers with provisional incomes between $25,000 and $34,000, and married couples filing jointly with provisional income between $32,000 and $44,000 can expect to see 50% of their Social Security benefits taxed. But those earning above these thresholds will see 85% of their benefits taxed. Traditional retirement account withdrawals are added on to your adjusted gross income, which pushes your provisional income higher as well. So you take that money out in retirement, not only do you pay income taxes on it, but it increases that provisional income that determines whether you pay taxes on Social Security or not. Roth account withdrawals are not considered provisional income, and you can withdraw as much as needed from those accounts without worrying that they'll negatively impact your Social Security benefits. So it's tempting to take the tax deduction that can come with traditional accounts now, but investors who want to maximize their retirement income should consider the consequences of kicking that can down the road. Whether you have a traditional or a Roth account, 59.5 is full retirement age. That is the age at which you can take withdrawals without being worried you have to pay an early withdrawal penalty for taking money out of your account. And there are some allowances for doing this before this age without having the penalty, such as buying your first home or some forms of disability. But without fail, 59.5 is full retirement age for an IRA, a traditional account, a Roth account, and what have you. And if you have a Roth IRA only, so not a Roth 403B, not a Roth 401k, but if you have a Roth IRA, there is an added benefit that allows you to access funds early without having to worry about an early withdrawal penalty, and that is the 5-year rule. See, if you've had your Roth IRA open for a minimum of 5 years, you can actually withdraw your contributions, so not the growth, but only the money that you've put in without worrying about an early withdrawal penalty before age 59.5. Now, if you have a Roth 401k or 403b, you do not have this feature, but if your plan offers loans, then you could use loans from that account just like you would a traditional retirement account. But being able to tap into some of that money with a Roth IRA before 59.5 is a feature worth considering. So again, I don't advise anybody to take money out of a Roth just because you can, or any other account just because you can, but it is something to consider when you're making that decision between the two. If you need something like a down payment for a home or investing in a business, knowing that you have a retirement account where you could at least take out your principal without being worried about a penalty affecting the spending power of that portion of your retirement fund. Please don't be confused by this video. There are absolutely reasons why one would choose to do a traditional account over a Roth account, even if both of them are available to that investor. Naturally, we're talking about Roth accounts today, so I'm telling you things about the positive benefits, the features that I think you'd like to know about to consider whether it's a fit for you or not. But it is no means, or by no means, a recommendation that you have to do a Roth account no matter your situation. So meet with the people close to you, meet with your advisors, go over all the information that you have, and make a sound decision for your particular circumstance. And hopefully this information gave you some things that will help you along that path. As always, if you like what you heard, please share it with as many people as you can. We want to help as many people as you can. And if you have a topic you want to be considered for a future video, you can do that by going to my website, www.brentonharrison.com. And under the blog section, there's a questionnaire you can fill out for topics you want to hear about in the future. We'll keep putting these videos out. Let us know in the comments what you think, what you want to see changed, and what you want to know more about. And we look forward to seeing you guys next time. Have a good one.